Xpeng is fresh off issuing 85 million shares on the Hong Kong Stock Exchange this week. China-based electric vehicle maker is now listed in both the U.S. and Hong Kong as it seeks to mitigate some geopolitical risk. Joining us now for more on the listing and the company going forward is Xpeng President and Vice Chairman Brian Gu. Brian, always good to speak with you. Thanks for taking the time over here this morning. So take us through this. This is known as a dual primary listing. So that subjects the company to rules and oversight of both U.S. and Hong Kong regulators. Why subject the company to that type of scrutiny?
I think this is it.
Sure. Yeah. Thank you. Very glad to be here, Brian. Dual primary listing actually, has a number of benefits. One is that the company can be actually listed independently in Hong Kong, which means that it does not rely on a listing status in the U.S. to trade in Hong Kong. Most of the secondary listing in Hong Kong actually relies on U.S. listing. So a primary listing gives us the independent listing and trading ability. Secondly, is that the primary listing in Hong Kong actually gives us the ability to be eligible for Stock Connect, which means that the China-based A-share investors can, through Stock Connect, buy our shares in Hong Kong, which will give us the access to the Chinese capital markets, which also allows some of our customers can be our shareholders, which is also always our objective. So those benefits outweighs the additional hurdles that we need to cross to be listed. But on the other hand, those hurdles also make our company stronger and more compliant because we now satisfy both the Hong Kong and U.S. standards.
And Brian, it's Julie here. It's good to see you. So is this also a move to mitigate some of the potential current regulatory risk we are seeing come out of China? Are you, as an executive at a company that is based in China and listed in the U.S. as well as Hong Kong, are you concerned that Chinese regulators are going to say you're no longer allowed to do that and you can't list in the U.S. anymore? How big a risk is that in your view?
Well, to be frank, our dual prime listing process, we weren't aware of these regulatory changes, so that wasn't really the factor that factored into our decision to come to Hong Kong. But these changes, which are introduced in the recent days or weeks, are very new. So we're really need to study it. But the good thing is that we're already listed in the U.S. and now we're listed in Hong Kong. So we actually have a very solid footing as a dual listed company in global markets. So I think we're very confident that we can actually provide stable access for our development to the capital markets.
And, Brian, certainly there's been a lot of focus on the stock over the last, really 6 months or so. It's been a name that's been, caught up in a number of different trades. I'm curious, though, about the business, because you guys, along with a couple of your peers in the China EV market, reported some pretty positive data for the month of June in terms of sales trends. And I'm just curious, how that is shaping up as we get into July here, and we think back to, the trajectory you rode in the first half of the year, and how you're thinking about the second half.
Yeah, I think the performance of our business, as well as the overall EV sector in China, has been really strong. I think surprisingly strong. If you look at our monthly delivery, which we disclose every month, we've been probably more than doubling on an annual basis for the 10 or 11 straight months. So that's astonishing. And also we have reported in our quarterly earnings that our gross margin has been increasing every quarter for the past 9 quarters. So not only the volume is increasing, but profitability is strong. So I think we're really, having a strong momentum in China. And if you look at the industry, the EV penetration in China has gone from 5% about a year ago to 10% today. It's more than doubled for the industry. So I think there is a strong wind behind our backs. I think it will carry through in the second half, because I think the second half typically is the stronger sales season for auto. So we are very hopeful that second half will have a stronger growth. On top of it, actually, we will be introducing brand new models. One will be the facelift G3, which is our first model. Now we have a makeover in the mid-cycle. And then the fourth quarter will be bringing our third brand new model, P5, to the market. So with 2 new models and the existing growth, we're very confident we can deliver stellar growth in the second half.
Brian, since you and I last spoke, Tesla has come under a lot more scrutiny in China regarding quality problems and how it sells its vehicles. Do you think Xpeng and even some of your competitors are gaining market share because of these stumbles?
Well, I mean, I think Tesla is still very strong in China. I mean, if you look at their delivery numbers in last month, they came back very strongly. It has a tremendous brand in local market. Its product still viewed as a high technology, one of the potential leaders in a number of areas. And also, I think that they are being very aggressive with pricing. So I think Tesla is still going to be a very strong competitors, and I think that they have a very commanding market share. Probably not as high as last year when they have a very dominating share. But on the other hand, I think the Chinese players are catching up very quickly. Our product and as well as some of the other products that are being introduced by the leading players have very good and comparable specs, as well as better user, features compared to Tesla. And I think we're catching up very quickly. So you can see that in the last few months, our growth has outpaced the industry as well as Tesla in China. But I think it's a long race because I think ultimately this market will not be dominated by one or two companies. It will probably be a number of players occupying probably large market share positions, for example, 10% and above. So that will probably likely to be the trend, and we hope to be one of those top players.
And Brian, I know Xpeng had started to export vehicles, I believe to Norway late last year. Do you think it's important that Xpeng goes global?
Absolutely. I think a smart EV as a product should be a global product. You should not be just design a technology for one particular market, especially that technology will involve the entire powertrain, the battery technology, the smart technology, autonomous driving. So much investment go into this product should make it competitive globally, not just in China. That's why we actually started the effort in Europe. We start selling in small numbers in Norway. We're building our presence in other countries in continental Europe. And I think for the next 4 to 24 months, we'll probably be launching our operations in a number of European countries. So I think by probably 12 to 18 months, we should have our capability built up in Europe. And then we want to introduce products that be designed for international markets. So I think that will be when we start to see larger number of our sales.
And Brian, finally, I want to circle back to the listing. And in particular, just to sort of emphasize the point here, for U.S. investors, is there a message that you want to get across to them amidst the sell-off that we're seeing, of course, not just in Xpeng, but in Chinese-based U.S.-listed companies broadly? Is there a message that you want to make sure American investors know about those U.S.-listed shares?
Yeah, I think one thing is maybe investor had to really look at the past and the longer horizon. I mean, Chinese ADRs has been one of the best better performing classes of security if you look at 10 years or beyond. So it has provided significant growth and opportunities for US investors. But also along the way, there has been quite a bit of volatilities. And, in years like 2012, in years, there are, similar issues have impacted the shares trading in the US. But in the long run, I think because China growth opportunity is still very compelling, I think investors, if you're taking a longer term view, will be very, very much rewarded.
All right, we'll leave it there. Xpeng President and Vice Chairman Brian Gu, always good to see you. Thanks for staying up for us. I know it's almost 10 o'clock over there in Hong Kong. We appreciate it.
Thank you.
Dan just highlighted some of the issues we've seen in Crowdstrike, cybersecurity firm, pointing to some numbers here that really shows how quickly this has escalated, saying that more than 1,000 big game hunting incidents have been reported so far, with roughly 46.5 targeted ransomware events per week. Let's bring in George Kurtz, who is a CEO of Crowdstrike. And George, we should start this conversation by sort of defining what big game hunting is, essentially criminals sort of studying their targets, getting within the system to install ransomware. I mean, that seems to really point to what happened in the case of Kaseya, but sort of how we've seen the threat elevated and then evolve increasingly from week to week.
Sure. Well, we've talked about it for some time. Big game hunting essentially has created an amazing industry to make money for the bad guys. And they've taken a lot of techniques from the nation state actors in terms of planning out, getting into an organization, being stealthy, and then activating their malware. If you contrast that to just a few years ago, where it was spray and pray, you get an email, you'd click on it, your computer might get infected, and they would charge you $300 in Bitcoin. Now it's much more planned out. It looks like a nation state attack. As Dan mentioned, they will steal data. Even if you don't pay the ransomware, they'll dump the data on the internet, but they'll activate the ransomware all at one time to inflict maximum damage into those organizations.
Hey, George, it's Brian Chang here. Now, I guess the question is, how is the fact that a lot of these attackers are, or at least the high-profile ones, could be these nation-state actors, as is the case what we saw with the Republican National Convention, as was reported by Bloomberg earlier this week. How does that differ than someone dressed up like Dan Howley in their basement doing it? I mean, when we talk about the nature of these attacks, it sounds like it's becoming more complex. So what is the proper defense, given the knowledge that we have now that these are more serious actors that are carrying out these types of attacks?
Sure. And we take at Crowdstrike an adversary-focused approach, and we break it down into three areas just to make it easy to talk about. One is nation state, which is the most sophisticated threat actors out there. Typically, they want to remain stealthy, they want to have access to a system, and they don't want to get caught. Then you move down in the hierarchy, and you have e-crime. And e-criminals, by their definition, they have to get in, they have to do something, and they need to get money out of you. So we see them much more, and we hear about them much more in the news than we do in the nation states that remain hidden. And then you have hacktivism, which we'll put that aside for a moment, but essentially it's focused on a cause, defacement of websites, things of that nature. And what we've seen at CrowdStrike, as you talked about in the leading piece here, is the massive increase in ransomware, almost 50 ransomware attacks per week, targeted ransomware attacks. And that is only getting worse because the money is available to the cyber criminals, and there's very little risk to them getting caught.
And you've highlighted the amount of money that's been collected here, $123 million in ransom demands with an average cost of $5.6 million. Dan just pointed to the dilemma that a lot of these companies face in, on the one hand, wanting to get the information back, and yet being told that you shouldn't necessarily be paying for this ransomware because that only enables the criminals. How do you think they should be thinking about it? It's at a time when it's becoming so prevalent.
Well, I've got to tell you, it's a hot topic at the board, right? And most boards right now. I've done a lot of calls with audit committee chairs talking about this and just trying to understand. They're trying to understand what they should do, how they should do it. What are the rules of engagement? And really what I tell them is it is a risk-based decision. You have to look at the facts. There isn't a clear-cut answer. Should you pay? Should you not pay? In some cases, it's going to cost you a lot more to try to get the systems up. There's a massive impact. And it might be the right thing to do to pay. We certainly don't advocate, we don't like to pay cyber criminals, but in the end of the day, it's a risk-based decision. I think what companies need to focus on is trying to prevent against those attacks in the beginning with things like CrowdStrike to be able to identify and prevent those attacks rather than have them on their systems. And as we mentioned earlier, even if you do pay, there's no guarantee that you're going to get all of your information back, that it's not going to be leaked again in the future and not going to come back for more money.
We got data from the Bureau of Labor Statistics earlier this week showing that the quits rate in May dipped to 2.5%, raising questions about whether or not we may have bottomed out on the labor market churn. But if you look specifically at the hard-hit accommodation and food services space, the quits rate actually remained elevated at 5.7%, which raises the question, how is all of this affecting restaurants that are trying to staff up to accommodate all those diners out and about this summer? Well, Damola Adamolekun is P.F. Chang's CEO and Paulson & Co. partner and joins us to talk about what he's seeing on his side of the industry. And I want to kick things off by asking, what is the labor market perspective that you're seeing? Is it difficult to staff up? How many vacancies is the company dealing with right now? And how is that affecting the business operations right now?
Yeah, no, we've as we ramp up, we've ramped up operations throughout the country as regulations have allowed us. So our demand for labor has increased, and the supply in the market hasn't quite caught up to that. So we're seeing some shortages. Some markets better or worse than others. But overall, we have about 2,000 openings that we're trying to fill. And what that's forced us to do is really kind of get creative around how we market ourselves as an employer. some of the things we can offer our folks who work for us, and think holistically about what it means to work for PF Chang's and make that proposition as attractive as possible for people who are looking for jobs in the market.
What specifically has been the pitch for you in terms of enticing workers to come on board? Is it about raising wages? Is it about increasing benefits? How have you tried to adjust the way you hire employees in such a tight labor market?
Yeah, we've done a few things. Compensation obviously is a part of it. We've always been very competitive on wages, and we continue to do so. Granted, the baseline has moved up, so being competitive means something different than it meant maybe last year or a couple of years ago. But that's a piece of it. Besides that, though, people really care about culture. They care about being able to have some sort of work-life benefit or balance, rather. And so we've been really thoughtful about making sure people who work for us, can have days off. We gave people the 4th of July off to spend with their families and, get some time to themselves. So it's compensation, it's balance, it's culture. And we happen to have a great culture, so it's making sure people are aware of that. And so our marketing team has gotten involved on the recruiting side, putting ourselves out there on social media, et cetera, to let folks know about what we're doing and the exciting story that's going on here, and how attractive it is to work for PF Chang's. Even in a tight labor market, there are people looking for work, and we want to get as many of those people as possible.
It's interesting because there's the COVID shock, which forced a lot of businesses to rethink the way that they distribute, specifically in the food services industry, their meals, right? Now, when it comes to PF Chang's, how have you adapted to that, but also adapting to maybe what this secondary shock of this labor market shortage when it comes to maybe automating some of the processes? How do you think about the way that your business is transformed in 2021 as we head into the latter part of this year?
Yeah, when we acquired PF Chang's, when I say we, you mentioned I worked at Paulson as well. So when we bought the business, we had a thesis around off-premises being really important going forward, and being a key part of our growth, over the next decade and for the years to come. So we've been focused on delivery, our digital presence, our app, our website, packaging, et cetera, in the year prior to COVID. So we'd really built up that infrastructure, which allowed us to transition people pretty seamlessly once COVID happened, and so, fortunately for us, it's been a focus. And so we were able to make that transition. We've seen digital delivery off premises all kind of step function increase during COVID, but it hasn't come back down. So dining has come back, but off premise remains elevated, which means that there's a more permanent shift in behavior than just kind of during COVID. People are now used to delivery. They're now used to technology, QR codes, apps, et cetera. So that's going to be with us going forward. And again, fortunately, it's something that we've invested in and we believe was the future even prior to COVID.
When you talk about digitization, automation, do you think that's going to be accelerated because of the labor crunch right now? I mean, that's always sort of been where things have been headed. How are you looking at different parts of the business that you think can operate with more tech investments and not necessarily more human capital?
We're not close to automation. Now, granted, our food is a little more complicated to make. We're cooking in woks. The kitchen is more complex. No offense if people make burgers. We're not dipping, burgers in fryers. It's a lot more complicated in the kitchen. So we're not close to automation, but what we can do is make things more efficient for people, right? So we're investing in technology to make, for example, our guest reservations technology, make it easier for the host to know who's coming in, make their jobs easier, payments at the table, order taking at the table, things in the kitchen, the KDS systems, et cetera. So we're investing in tech to make our people more efficient, to balance out the shortage in labor. And that's a focus for us as well. It's something we've been working on through COVID and has let us do more with less effectively, which is, the situation that we're in, just given the labor market.
I want to ask about commercial real estate. So obviously there was a lot of kind of moving around. Some malls just kind of died during the midst of the pandemic. Sometimes PF Chang's locations can be anchored to those mall tenants. Did you restructure a lot of rents during that time? How are you thinking about expansion? Because PF Chang's has a very iconic kind of presence when it comes to the outside of the store, very much like Cheesecake Factory. Everyone knows those white horses when they walk up to the restaurant. So do you have a lot of mobility when it comes to your CRE strategy and your expansion?
We're in malls, but we're typically not in the malls. We're kind of off to the side or standalone in a mall area. So Our mall locations don't perform any different, even during COVID, to our non-mall, just because, again, we're an attraction and destination separate from the mall. And we do benefit if there's traffic, but we're not dependent on that. We're not in a food court, for example. So, just that helps us. But your broader question around real estate is a good one. I mean, so, during the pandemic, we had to, have conversations with our landlords. Fortunately, we have great relationships with all of them, some of the largest landlords in the country we work with. And, they understood the situation. We worked together and we were able to kind of, reach agreements that allowed us to continue to operate our business and allowed them to be made whole at some point. So, we reached those agreements. Now we kind of turned the page on that and we're talking about growth. We're talking about expansion. We're talking about new units. And that's a, much more optimistic and fun conversation than the previous conversation. So, people are in a good place. They love the brand. They want PF Chang's in their malls. And we're looking to expand. So now we kind of look forward and chart that path and, figure out what comes next for us.
And finally, we talked so much about wage growth and how that's likely to pressure your business. But what about food prices? And we've seen so much of that spike. A lot of business owners who are saying that at some point they're going to have to pass that on to their consumers. What's the thinking inside the company right now?
We have seen food inflation. I think that's been consistent, throughout the industry. In some categories more than others. Chicken, flank, oil has seen massive inflation. Now we've seen some of that start to normalize, and we do think it's temporary because demand has ramped up faster than supply. A lot of supply chains were kind of shut down during COVID and are starting to come back and catch up. So we think it's temporary. In terms of our reaction to it, we're kind of managing it on the cost side. We haven't taken price against it. We want to kind of see how it plays out. If it comes back and normalizes like we think it should, then we don't want to be aggressive on price and drive away guests. Kind of make a long-term problem to deal with what is a short-term, cost issue. So we've been cautious on price. We haven't, taken price as a result. We've kind of managed it, with our suppliers, and we're seeing it start to normalize, and we hope that continues.
Damola Adamolekun, PF Chang's CEO and Paulson & Co. partner. It's good to talk to you today. Appreciate the time.
Well, many hotels, bars, and restaurants have struggled to find workers, so many raised wages, yet labor shortages have persisted. So does no one want to work in the hospitality industry right now? Here's Sibile Marcellus with the latest installment of Career Control.
Joblist is out with a new report that shows that hospitality jobs are unpopular right now, and that even raising wages doesn't seem to be reeling people in with the pandemic. Check this out. Even celebrity chef Wolfgang Puck has been complaining about this. At his restaurant Spago in Beverly Hills, waiters can make $120,000 a year, yet he's still struggling to staff up. Another celebrity chef and restaurateur, David Burke, recently told Yahoo Finance that he had to raise payroll by 25 to 30% just so he could retain and attract cooks and waiters. I want to bring in Nick Bunker, Economic Research Director for North America at the Indeed Hiring Lab, to break this all down. Now, Nick, we're hearing from some employers that they're struggling to find workers. Now, according to JobList, 60% of job seekers overall are not interested in jobs in hospitality, but the unemployment rate is still pretty high. So why aren't more job seekers feeling this sense of urgency?
Well, I think for the first of all, there's the fact that there's lots of people who are job seekers who just aren't going to be interested in the hospitality sector. For example, if I were looking for a job, that's just not my career, so I wouldn't be looking there. I think the overall sort of sense of the labor market right now is that while there are people out there who will take jobs, there's not a sense of urgency for many job seekers because of COVID and the fact that lots of people have financial cushions built up during the pandemic. So while employers might want to staff up urgently right now, lots of job seekers don't feel that same sense.
Now let's talk about people who previously worked at hotels, bars, and restaurants. Now this finding really stood out to me. Over 50% of former hospitality workers say they would not return to their old job, even though they're seeking new work, and even if there's increased pay or more incentives. From your perspective, Nick, how significant is that?
I think prior to the pandemic, this sector of the labor market was relatively high turnover. So it does make sense that in this period of more opportunities that folks who had previously worked in this industry would be willing to switch jobs. I think the issue here is how much of the experience of the pandemic potentially changes the appetite for those workers to stay in the industry.
And where should employers be looking for potential employees for the hospitality industry?
Well, I think the fact that we just mentioned the high quits rate or the sort of high level of churn in that industry, I think this just suggests that if you're looking to staff up, you might have to turn and look at the people who are already employees in the sector. That's a group that is working right now and seems more likely to be lured by higher wages.
And given the increase in wages as we've been talking about, is now the best time ever to work at a bar, restaurant, or a hotel?
I think in terms of negotiating for a raise, I think right now is a really opportune time. The demand is really strong across the whole labor market, and particularly in leisure and hospitality, an area that's trying to reopen. I think the question is, are we going to see this level of demand in the next few months? And then also, are other job seekers maybe going to come online? So the opportunity is there right now. Folks might want to seize it when they can.
And unlike in many industries, working in hospitality requires you to be on site or in the office. So how long do you think it's going to take this industry to recover?
Well, I think the major factor here, as it has been for the last 15, 16 months for this industry and the economy overall, is the path of the pandemic. Hopefully, with the level of vaccination we have now and continuing progress there, case counts will go down. More people will feel comfortable going to restaurants, especially in-person dining, and more people will feel comfortable going to in-person jobs like those in this sector. So I really do think that the immediate term outlook for this industry is very dependent on what happens with the pandemic in the months ahead.
Absolutely. Many people hoping that we move past this pandemic. Nick Bunker, great to have you on. Thanks so much.
Thanks.
All right. Thanks so much, Sibile Marcellus, for bringing us that conversation as a part of the latest installment of Career Control. Welcome back. Well, Bitcoin and other cryptocurrencies are sliding today as investors really take a risk-off approach. How long could this risk-off mood last? Well, let's find out. We're joined now by David Grider, Fundstrat's lead digital asset strategist. So David, I was reading through your notes and you remain bullish on cryptocurrency. Tell us a little bit more about why, and do you think some of these dips that we're seeing right now are buying opportunities, or do you think that for Bitcoin, for example, we could see it sink even lower?
Yeah, first of all, thanks for having me. I think that, the first thing investors should be thinking about kind of in the current market that we're in right now is, we're going through a phase where, crypto is digesting some gains that it had during 2020 and the first part of 2021 that were pretty stellar relative to most other assets. And I think that this kind of retracement has been kind of part of a digesting of those gains. And we're in a consolidation phase right now with the market seeing, working through some of the negative headlines that we had earlier in the year and in kind of a choppy sideways market. Some of the things that we've seen recently are, the market has been kind of on a little bit of lower volume in the summer doldrums a bit. We think there's been a little bit of sell in May and go away type of investor attention kind of looking elsewhere and kind of taking their eye off of crypto lately. But we think that the fundamentals are still strong on crypto over the long term, and it's kind of a generational investment play that we're very optimistic about.
So curious to know, as you're talking about, Bitcoin really retreating from some of those highs, where do you think we are right now in the Bitcoin cycle? Now, your note mentions that we could be at heading into a fourth cycle, or do you think we're at the beginning of a downside trend, or do you think that there could be some continuation to the upside here?
Yeah, I think that is the big question that a lot of crypto investors have on their minds. To recap for folks who maybe haven't been following the space as closely as others, Bitcoin and crypto they're like emerging market digital economies. And most economies, they go through kind of boom and bust business cycles and price valuation cycles for many of the assets. And we've gone through a few waves of those cycles, and they really do have a lot of relationship to the macro environment that we see as well, and then kind of translate around kind of what's happening in the global macro economy. So if we look back to like the prior cycle, for example, there was a mid-cycle pause back in 2017, kind of through the middle of the year, where we had some healthy retracements. It's kind of like we had now. And, I think that the question on a lot of folks' minds is, was this kind of the end of 2017, December, end of that cycle to a bear market, or was this kind of a mid-cycle pause? And I think that the things that folks should be considering and thinking about when kind of making that judgment are, one, I think this cycle drawdown in this recent months was a little bit amplified due to some of the things around the way the market structure has changed, with a little bit of increased leverage, some negative news that had happened with China, but we're also seeing similar things to other asset classes. So like we've seen with some of the cybersecurity news in the recent IPOs, right? And I think that the other part of it is that most important is really what happens with the macro picture and how does that kind of shape up through the balance of the year. And that should be kind of the main driver in our view.
All right, so we're halfway through the year now, and I was looking at some of the price targets that you had. They were pretty aggressive for Bitcoin and for some of the other cryptocurrencies, and we are far away from some of those price targets that you have. And we've also seen some huge slides backwards away from those run-ups that we've seen so far this year. So now that we are at the halfway point of the year, has anything changed in terms of your outlook for the remainder of the year, or perhaps even in some of those price targets that you have?
Yeah, just to give viewers a little bit of back context, we've been at buy on Bitcoin since March of 2020, kind of following the COVID sell-off, and that was around $5,000. And we've been also recommending overweight on Ethereum since around then. And I think the most recent price targets that you're referring to are our current $100,000 price target on Bitcoin and our 10,000 price target on Ethereum. We've been raising our targets kind of along the way as the market has moved higher. We most recently raised those back in January with our January outlook, and we got about halfway or a bit farther for both. And we've had a bit of a pullback since. And I think that if we're kind of evaluating the picture right now, we're maintaining those price targets for year end. I think that as long as the macro picture kind of stays healthy, I think that's going to unfold as many of the folks watching the market are watching it unfold. And that's things like what happens with the Fed, what happens with global risk on assets. As long as those things kind of stay healthy, I think that the picture could be intact for kind of Q3 being a healthier bounce for crypto.
So I do want to ask you, David, just because we've seen a lot of sell-offs, every time Elon Musk tweets, anytime we hear China essentially wanting to crack down on Bitcoin or new regulations on cryptocurrencies, I'm curious to know if you think some of those bad headlines are really going to abate as time goes on, or, how should investors really be thinking about cryptocurrency, given that we see these volatile price swings every time a bad headline comes out?
Yeah, I think the first thing to keep in mind is crypto certainly is a volatile asset. I mean, it's, these are small digital emerging market economies, and like many, smaller economies, very susceptible to capital flows. I think that some actual interesting change in the market dynamic that we've seen recently is, since kind of the end of Q2 and kind of into the most recent weeks, we had been seeing negative headlines taking the market lower, and that had been really driving a lot of some fear and some selling in the markets. We saw things like China and Elon Musk, as you mentioned. But the interesting dynamic that has kind of shifted over recent days and weeks has been that we've actually seen some negative headlines coming out around some regulations, some continued things happening in China. And we've actually seen the market start to actually be able to rally on those types of negative headlines. And that's really kind of a shift in sentiment. It might also be a sign that you've kind of seen seller exhaustion from the folks who are maybe have a higher tendency to sell with these types of headlines, these types of news. So I think that is encouraging. I mean, we are in a little bit of a lower liquidity period. It is kind of the doldrums of summer in terms of volume. So the market is a bit more prone to some volatility. But I think that that is kind of one encouraging thing that we've seen kind of start to change over recent weeks.
All right, David Greider, Fundstrat's lead digital asset strategist. Thanks so much for joining us. I want to continue this conversation on the energy markets, really with a specific focus on oil now with Pavel Molchanov. He's a Raymond James energy analyst. Pavel, thanks so much for joining us today. Now, I want to start on that OPEC Plus meeting that Jared really ended with. Essentially, we have this impasse here. I think some folks thought that this impasse would have been broken by now. What are you anticipating from OPEC Plus moving forward, especially as the oil price spikes essentially are encouraging some of these countries to take more of an individualistic approach?
Right. It is indeed the case that after a year and a half of amazingly strong discipline on the part of OPEC and Russia, those countries are, breaking apart a little bit in terms of their cohesion as a group. Look, $70, $75 oil will do that. There is simply not the same sense of urgency that existed 12 months ago or even 6 months ago. So more appetite on the part of individual members to go it alone.
So then what do you anticipate comes next? Because, I've been reading and some folks are suggesting that there's a couple of different scenarios that happens here. One, there could be a flood of oil to the market as, each of these countries decides to ramp up some production, but also then that we could see essentially the current deal stay in place. What are you thinking happens next?
Well, the short answer is that politics of OPEC is hard to predict. And I think ultimately every member will do what they think in their own best interest. So, it may well be that Saudi will stay disciplined, but some of the smaller members will, ramp production back up. Again, that has historically been the case in the context of recoveries. But the other question we need to ask, and indeed the OPEC countries are asking themselves, is what's going to happen with demand? We know that demand has improved a great deal versus the bottom of a year ago, and in fact, even from 6 months ago. But now we're getting some headlines related to the spread of the Delta variant that are more concerning, perhaps than they were 30 days ago. And so part of the decision-making process for OPEC as a whole and every member is they want to modulate supply in accordance with what they expect demand to do. And as we're seeing, that is highly variable, literally on a week-to-week basis.
I'm glad you mentioned that point about the demand because there has been such a bullish outlook as we have seen this pent-up demand, especially as folks are starting to hit the road and start traveling again. Do you think that demand is going to wane as we do see this Delta variant really start to sweep the entire globe and we start to see some countries essentially put in place some of those restrictions again?
So here's the amazing statistic. Today, 940 million people, almost 1 billion people worldwide are in what we define as lockdown, which is closures of non-essential businesses. That is actually more than in January. Now, we know that the US has essentially opened up, and we know that most of Europe has opened up, but there are plenty of emerging markets like India, Indonesia, South Africa that are in worse shape today than they were at the beginning of the year. And even some of the developed economies like Japan, we're hosting the Olympics pretty soon, Taiwan, Korea look problematic as well. So it's not enough for us to just look at the domestic picture. Let's remember 80% of the world's oil is used outside of North America. So we need to take a holistic view of this.
I want to ask about U.S. crude, if you think that we could see an uptick there in that production.
Well, as far as supply in the U.S. and indeed just about anywhere outside of OPEC, that's not likely at all in the next 6 months. Capital budgets across the board this year by oil companies are the lowest they've been in decades. Maybe that will change in 22. We will find out at the end of the year. But as it stands, we're not looking for U.S. supply or Brazilian supply or North Sea supply. to pick up for quite a while. The entire industry is so fixated on discipline, capital discipline, supply discipline. So OPEC countries have the ability to ramp production back up at their discretion. But in the US, the rig count is at a level where there's just not going to be production growth, in the foreseeable future.
And just last one for you here. I think this is the question that so many folks are really wondering because, a lot of consumers have been paying a lot of attention to what's been happening to oil lately because they've been feeling the pain at the pump, so to speak. So let's just ask how much longer you think that could continue.
Well, I'll take a step back and say that U.S. consumers actually have it really good when it comes to fuel prices, globally speaking. Yes, of course, prices are higher than they were a year ago or 2 years ago, but compared to what their counterparts pay in across Europe, in Japan, in Australia, it's much cheaper. Even in California, most expensive gasoline, it's cheaper. So if demand gradually recovers to pre-COVID levels by, let's say next summer, and OPEC continues to, ramp production back up, we think that the price of crude, the main determinant of gasoline, obviously, will be flattish to slightly up from current levels. And it's worth pointing out the commodity market is actually signaling that prices will go down from current levels. We disagree. We think prices are more likely to be higher, not dramatically, but maybe a little higher by the end of the year than they are today.
All right, Pavel Molchanov, Raymond James Energy Analyst, thanks so much for joining us today.
And we want to bring in Dr. Jeremy Faust. He is emergency medicine physician at Brigham and Women's Hospital. And doctor, it's great to have you. What Anj just ended on there, talking about the fact that the Tokyo Olympics is not going to allow spectators. I guess we also have to recognize the fact that there's going to be around 11,000 athletes heading to Tokyo. When we have Japan in the current situation that they're in right now, is it possible to hold the Olympics in a safe manner, do you think?
Thanks for having me. My view on this actually is that it could be safe to hold the event and relatively normally, but you have to do one thing well, and that is to test frequently with a combination of the PCR tests and the rapid tests. They can do this for a fraction of the cost that they've already sunk into this. So for the last mile, they can spend a little bit more money, test everyone all the time, and really almost be sure that there's going to be no outbreaks. If they want to also make vaccinations a requirement for attending the venues, they can have that because it's safe and it gives people a really good reason to get vaccinated. Look, everyone, if you get vaccinated, you can go to the Olympics. I think that's a great message to send, and I think it could be done safely.
Dr. Anjali here. Looking at of course, the vaccination rates, the country, we know we're seeing some surges in areas that are low or no vaccination. How does that pan out for the rest of the year? Could we see surges in areas of high vaccination? Is that a concern?
I think we're going to see in the United States case counts go up anywhere it's possible because of breakthrough cases. But the question is, will there be actual hospitalization surges? My prognostication here is that you're only going to see major hospitalization surges in areas of a low vaccination rate. Because right now we know that Delta can break through to some extent, but you look at Israel, there's a spike in cases, but there's not really a spike in hospitalizations. So barring another variant or barring waning immunity, I think that the breakthrough cases in the vaccinated are going to be just that, cases. Whereas cases in the unvaccinated, places like the South right now, Missouri, Arkansas, where you actually have so low rates of vaccination that it's just infection without protection, and we're back to square one with those folks. So I think you're going to see Delta make it more punishing sooner for people who have decided not to get vaccinated.
Doctor, in fact, real world case here, we were supposed to have plans last weekend with some folk, one of whom is about 82 years old, has the double vaccine and was a breakthrough case, got tested positive for COVID. But the symptoms were basically a flu, and that individual is, on the mend. So as you said, no hospitalization. But can that individual, even with the vaccine, because we keep hearing if you're not vaccinated, you become a breeding ground for variants, could the individuals, those of us who are vaccinated, who might become breakthrough cases, are we not also breeding grounds for new variants?
That's being studied. I think that the question number one is, if you get a breakthrough case while fully vaccinated, how sick can you get? And the answer is mostly not. Then the next question is, can you spread it? We now know that after one dose, there's some degree of decreased spread, but we think that after two, it's a lot less. And then the question is the amount of time that the virus is in your body decreased by enough that the variant risk goes down a lot? These are things that we're studying actively. So far, the reason that the CDC dropped the mask mandates was not based on those data, because they don't exist. It was based on actually surrogate data saying, well, how much virus did we culture out of the noses of people who were having breakthrough cases? And the answer was a very small amount. That augurs well for the question you're asking, which is it likely that you and I could be a breeding ground? It's possible, but it's highly, highly reduced.
Doctor, there's also questions now about a new variant that has been sort of in the news, not necessarily a big concern just yet, out of Peru, Lambda. What can you tell us about that and the potential threat to the U.S.?
Yeah, this is a variant that's being watched, not yet an official variant of concern. And look, this virus, it mutates, right? And some of those mutations, most of those mutations are completely meaningless in the sense of it doesn't cause any change to the virus's function or ability to spread or do harm. The ones we hear about tend to be the ones that have some increased contagion or something else that sort of makes it outcompete the other versions of the virus. So what I can tell you is just the fact that we've heard of it, the fact that it's making a headline here or there, tells me that it's likely quite a contagious variant. But the question is it like the other ones where there hasn't been a major increase in the severity of disease? Certainly with the UK variant, for example, we saw a small increase in the severity of disease, but nothing that really changed the overall epidemiologic curves. So the question is Lambda or the next one, whichever we're going to get down to Omega at some point, right? Are any of these variants actually both more contagious and more harmful? And the worst case scenario, of course, do they cause problems with the vaccine in terms of that vaccine's ability to keep us all out of the hospital? We're watching that and we don't know.
Doctor, you mentioned masking before. I just want to go back to that because I think a lot of people are trying to figure out whether or not they should be masked up when they go indoors, because we've gotten some conflicting guidance. I guess the WHO, LA Department of Health is urging people to wear masks indoors. CDC has yet to say that. I guess what's your view right now, and what are you doing when you go inside stores or in public places?
Well, the WHO has a consumer base, which is the entire planet. And most of the planet is not vaccinated. So if they're going to make one sentence and that's the only sentence that anybody hears, they want it to be applicable in the places that have no vaccination. So they're going to say masks, and even if vaccinated, masks, because they just don't want to be confused for saying anything other than that, because frankly, it's haves and have-nots, and they're most worried, and appropriately, about the places that have no vaccine or low levels. In the United States, I think that in areas of high vaccination rates, like where I live in Massachusetts, we have no excess mortality right now. Hospitalizations are at a low. I think that if you are around unvaccinated people, that's one thing. But if you know you're around vaccinated people, I'm still not masking. But I will tell you that that's a moving target that can change with breakthrough numbers. I think that the thing that people worry about is breakthrough cases and breakthrough spread. I still think that in areas of low case counts and high vaccination rates, it's okay not to be masked if you know the situation. But there are also some low-hanging fruit. When you get into a taxi, an Uber, Lyft, or the subway, I'm going to wear a mask just because that feels like the public health thing to do, even though that's not necessarily going to stop a spread in an area like mine where there's less than one case per 100,000 right now.
Dr. Jeremy Faust, always great to get your perspective. Thanks so much for taking the time. And of course, our thanks to Anjali Kamlani as well.